Hello everybody, this is Lara with your end of the week video for US oil for the trading week ending Friday 21st of August. Another really small range week has moved price higher, but it hasn't made a new high. Both the Elliott Wave counts remain valid. Oil may still have found a major sustainable low, I expect. The simplest Elliott Wave pattern is a 5-step forward pattern, and within that bigger picture I'm seeing oil with 1, 2 complete, now 3 beginning, and then 4 and 5 in the future to unfold. Some core Elliott Wave rules state that the third wave must move beyond the end of the first wave. Another core rule states that the fourth wave may not enter first wave price territory, so that tells us that the third wave has to move far enough above the end of the first wave to allow room for a subsequent fourth wave to unfold and remain above first wave price territory. So this is now a very bullish Elliott Wave count. A third wave may only subdivide as an impulse. This structure here for super cycle wave 2 is a double zigzag, and I'd long expected back up here. My analysis for oil was very bearish. I had expected this, and my target was, I think it was 9.77, so this was pretty close. And we've got some strong technical evidence that we do have a sustainable low. This looks like a really nice V bottom. The structure is a double zigzag. Here's the first zigzag in the double. It's labelled cycle wave W. The double is joined by a 3 in the opposite direction. It's labelled cycle wave X. And the second zigzag in the double over here is labelled cycle wave Y. And the purpose of Y waves within double zigzags is to deepen the correction when the first zigzag doesn't move price deep enough. And this absolutely certainly achieved its purpose. And so now let's focus on the start of super cycle wave 3. Let's go back to this low. We're going to look at this at the weekly chart level, this point here. And super cycle wave 3 must subdivide as an impulse. I'm moving the degree of labelling up 1 degree within this, and I'm going to see cycle wave 1 over recently, and now cycle wave 2 continuing. It looks like oil is forming a slow, curving, rounded top. And when that top has formed, and I'll expect eventually in a few weeks possibly a pullback to develop a little bit of strength for a second wave. I do at the daily chart level, but once we get further into the structure of cycle 2, I'll start to try and refine the target for you. If my targets are wrong, they may not be low enough, because particularly for this market, its first huge correction within a new trend can be really deep. Cycle wave 2 may not move beyond the start of cycle 1 below 10.24. When it's complete, we'll be expecting a third wave at cycle degree within a third wave at super cycle degree. Let's take a look at 2 daily charts I have for you. The first, we'll see cycle 1 over here, this point here, and cycle 2, an expanded flat correction. That's actually a pretty common Elliott Wave corrective structure. From this low to this high, this looks really good as a completed 5-wave impulse with an extended third wave. And when third waves extend, they show their subdivisions at higher time frames. What I mean is, if you look here at primary wave 1, you can't see at the daily chart level the second and fourth waves within it. You have to go down to the hourly chart level to see that. But here, within primary wave 3, you can see intermediate 2 and intermediate 4. They show up quite clearly to give this third wave a 5-wave impulse look to it. And so when third waves, particularly, because that's a really common wave to extend, when they do that, they don't just extend in price, they tend to also extend in time, because their corrections are more time consuming than counterpart or the same degree corrections within the other waves. So 1, 2, 3, 4, 5, an impulse looks likely to be over here. This looks really typical. And so a second wave may have begun here as an expanded flat, subdividing 3, 3, 5. Expanded flats have B waves, which make a new price extreme beyond the start of the A wave. And like I said, they are fairly common structures, particularly in a B wave position, although here this one's in a second wave position possibly. that's okay. Second waves can subdivide as expanded flats. The target for primary wave C is for it to reach 2.618 times the length of primary A. That's the Fibonacci ratio I'm using because here primary B is 1.5 times the length of primary A. That's a little bit longer than the most common range of up to 1.38 times the length of primary A, but well within allowable guidelines of up to 2 times the length of primary A. Primary wave C must subdivide as a 5-wave structure. 1, 2 could be complete. Now we need 3, 4, 5. Most likely an impulse, so 3 has to move beyond the end of 1. 4, a bounce must unfold and remain below 1 price territory. And then 5 would be most likely to move beyond the end of 3 to avoid a truncation. Cycle wave 2 may not move beyond the start of cycle wave 1. Alternatively, there's another way of labelling this big bounce. 1, 2, 3, 4, and an ending contracting diagonal for the 5th wave. This just doesn't have as good a look as the first wave count, but again, as always, let's consider all possibilities. It's possible oil could meander a little bit higher before a pullback really does start to develop some strength. I need to move the degree of my labelling of my notation here up. This is intermediate 4 in validation. Intermediate 4 may not move beyond the end of intermediate 2. There are limits to upward movement here based on the Elliott wave structure. Here it's a visual illusion. Primary wave 1 is actually longer in terms of price distance travelled than primary wave 3. And so because primary 3 may not be the shortest out of 1, 3 and 5, that's a core Elliott wave rule, that means primary 5 is limited to no longer than equality in length with primary 3 at 5, 4, 3, 3. Intermediate 5 is limited also to no longer than equality in length with intermediate 3 because this is an ending contracting diagonal. If this limit is passed, then the higher limit applies. If this limit is passed, what that means is my labelling of this structure for primary 5 is wrong, but it doesn't mean my labelling of 1, 2, 3, 4 for primary degree in these positions is wrong. Looking now at this possible structure of primary 5, an ending contracting diagonal, 1, 2, 3, 4, 5. 3 is shorter than 1, 4 is shorter than 2 in terms of price distance covered. The trend lines are converging. 5 must be shorter than 3. It may not move beyond the limit where it reaches equality in length with 3 at 46.25. It may end with a small overshoot of the 1-3 trend line. So if we do get a new high for oil beyond this point, then look out for a little overshoot of this trend line before a trend change. At the weekly chart level, it does look like oil may be forming a slow curving rounded top, and I'd expect it to continue along for a few weeks yet before it starts to develop some strength to the downside. Price is now just above support, about 42, but there's a really strong cluster of resistance above, which may assist to halt or force the slowing of price and force a pullback. If this is a new trend, and it certainly looks like it is, we've got a couple of really, really strong hammer candlestick patterns down here. The downward trend reached really extreme. There was bullish divergence between price and RSI, all of those things to indicate that we had a sustainable low in place. So this was absolutely expected. Within a new trend, there will be a big pullback early on, and usually it's pretty deep. It doesn't have to be a sharp, quick moving one, and this is turning out to be a very slow, drawn out affair, but I do expect it will happen. It looks like a rounded top is forming. For the last couple of weeks, upward movement sees declining volume. That's bearish. The volume profile is bearish. ADX is now below both directional lines. There's room for a new trend to develop now. ATR is declining as price rises and it hits resistance. There's a lot of weakness in upward movement. The last signal from on balance volume was a weak bullish signal. RSI in neutral territory, stochastics overbought. At the daily chart level, this rounded top is a little bit more obvious. The moving average situation is now overall bearish. The short and mid-term averages are below the long and price is just above the long, and the long-term average is negatively sloped. But they're getting clustered together, so it's moving from an obviously bearish situation into a more of an inconclusive situation. These are moving averages, and so they are lagging indicators. The last two daily candlesticks have little long lower wicks. These are little hammer patterns, but the bullish implication of a long lower wick on a hammer candlestick really does require bearish confirmation from the very following candlestick, and so it's really more of a two candlestick reversal pattern, which is why I haven't noted it on this chart. If Monday opens with a red candlestick, then you can read the three of them as a bearish conglomeration of candlestick patterns and have more confidence in that rounded top is forming and on its way down. ADX is declining, there's no clear trend at this time frame. On balance volume is broken below support, so that's a short-term bearish signal. RSI in neutral territory after exhibiting double bearish divergence at highs. Plenty of room for price to fall or rise. Stochastics, that's not neutral, that's returning into neutral territory, and MACD bearish. That's all for me with your oil analysis this week. I hope that all of our members are having an awesome weekend.